Welcome. In this video. Where will ZBCN coin go from here? We will analyze it. Don't forget to subscribe, and please watch to the end to understand. One of the notable technical formations evident in the chart is the ascending channel pattern, which has become quite clearly defined in the current price structure. Such formations indicate that prices are in an upward trend over a specific time frame, but this uptrend occurs within certain limits and channels. In other words, the price is not rising randomly. Rather, it is moving systematically within a defined channel while attempting to climb higher. This channel consists of two parallel lines, the lower band, which acts as support, and the upper band, which serves as resistance. The price moves in a zigzag pattern between these two lines and typically remains within this channel for a while. Looking at the current price position, the asset appears to be testing the lower band of this ascending channel. This lower band has historically acted as a strong support level, with the price often bouncing upward towards the midline, or even the upper band, whenever it reaches this zone. This is a critical detail for investors, as in technical analysis, levels that have previously acted as support or resistance tend to continue serving those functions in the future. Therefore, the price being near the lower band currently may signal a potential upward move. It's also important to remember that the lower band can be interpreted as a demand zone. At these levels, buyers typically become more active, selling pressure decreases, and the likelihood of a price reversal increases. In this context, a bounce from the lower band is a normal and expected scenario from a technical standpoint. If such a reaction occurs, the first target would likely be the midline of the channel. The midline is not only viewed as a short-term target, but also serves as a decision point. At this level, the price either gains momentum and continues towards the upper band, or it pulls back again toward the lower band. Being able to correctly analyze price behavior in such ascending channels is key to making successful trading decisions. In the current scenario, the price hovering near the lower band also offers investors an advantage in terms of risk-reward ratio. Positions taken near the lower band typically yield favorable short-term outcomes, and stop-loss levels can be clearly defined in such strategies. If the price breaks below the lower band and starts to sustain those levels, it could indicate the beginning of a breakdown in the channel structure. However, that is not the case at the moment. The price has approached the lower band and is currently seeking balance. Another point that should not be overlooked is the psychological impact. Investors frequently monitor these types of ascending channels, and because price movements within the channel tend to follow a pattern, expectations for continuation increase. As a result, positions taken near the lower band are often seen by many investors as a rational buying opportunity. These psychological factors, when combined with technical analysis, can produce strong signals. Additionally, investors should pay close attention to any movement outside the channel. If the price decisively breaks the lower band and this break is supported by strong volume, it could be a major signal that the ascending channel pattern is ending. However, there is no such breakdown signal in the current setup. On the contrary, the price seems more likely to bounce upward after testing the lower band. This represents a potential opportunity for investors. In summary, a price structure moving within an ascending channel is considered a healthy trend pattern in technical analysis. The fact that the price is currently touching the lower band may signal a short-term reversal. If this reversal plays out, the midline becomes the first target. Should the price break above the midline, a move toward the upper band is likely. However, we cannot rely solely on channel analysis. Let's take a look at other metrics as well. Stay tuned. One of the key structural elements evident in the chart is a bullish order block located just below the current price, which has repeatedly proven itself in the past. These types of structures represent areas dominated by buyers, zones where demand is concentrated. These are typically regions where high-volume buy orders, often placed by institutional investors or large capital holders, have previously triggered strong upward price reactions. Therefore, the presence of such zones is critically important from a technical analysis perspective. In the current chart under analysis, this clearly defined bullish order block just below the price has been tested several times in the past, each time leading to an upward price movement. Such zones are not only considered as support levels, but also as strategic thresholds that can determine market direction. This is because these blocks are typically where large players enter positions. Hence, if the price approaches this area again, it is highly likely that a strong wave of buying will re-emerge. In other words, order blocks function like the market's memory. When we look at past price behavior, we often observe increased volume, stronger candlestick formations, and a shift in market sentiment toward the upside at these block levels. Such data makes technical analysis more meaningful and predictable. Now, with the price approaching this bullish order block, it may represent another opportunity zone for investors. Furthermore, bullish order blocks play a significant role not only in interpreting historical price action, but also in shaping future expectations. Trend reversals often begin at such strong blocks. Just as the price responded with upward movement upon reaching this level during previous declines, a similar scenario now would not be surprising. This highlights that the zone is not just a support level, but also a potential launchpad for a new bullish wave. Another important point to remember is that such blocks are also critical in terms of liquidity. Large investors tend to accumulate liquidity in these areas, buying heavily where retail traders are selling, thereby beginning to take control of the price. Therefore, holding this kind of zone without a breakdown is crucial for sustaining bullish scenarios. Sometimes the price doesn't just touch a bullish order block, but moves sideways around it for a while. This signals indecision in the market. However, this kind of sideways movement is often a precursor to a directional breakout. If the price begins to rise and this move is supported by increasing volume, it marks the beginning of a new trend initiated from this block. The way the price approaches this bullish zone is also important. If the price moves slowly and with low volume toward the block, this typically suggests a strong reaction may follow. On the other hand, if the block is reached through a sharp, high-volume drop, the risk of the block being broken increases. Therefore, not only the technical structure but also the manner in which the price approaches it must be considered when making decisions. If this order block proves effective once again and the price bounces from it, this could set the stage for a new bullish wave on the chart. In this scenario, the initial targets would be previous high levels or horizontal resistances. As these targets are tested over time, momentum in the market increases and the price begins to attempt higher levels. Especially after such bounce moves, the market typically goes through a short-term consolidation phase before continuing with greater momentum. The MACD indicator is a powerful technical analysis tool that plays a critical role in understanding market dynamics by measuring momentum and trend changes. Currently, a notable development on the chart is that the MACD line has started to make an upward move from the lower region. Such upward movements typically indicate that bearish momentum is weakening and buyers are beginning to gain strength. Especially when this crossover occurs well below the zero line, it is often considered an early sign of a potentially strong upward move. In these scenarios, when the MACD signal line and the main MACD line converge in the lower region, and the MACD line then crosses above the signal line, it signals a shift in trend direction from downward to upward. This move is referred to as a bullish crossover in technical analysis. A bullish crossover may indicate that the price has started to stabilize at previous low levels and is now building upward momentum. If this crossover is supported by sufficient volume, it usually results in a rally or a strong bullish move. Another important point here is the MACD line's movement toward the zero line after the crossover. The zero line represents a critical threshold in MACD that ultimately confirms the direction of the trend. When a crossover starts in the lower region and gains upward momentum toward the zero level, it draws the attention of market participants. We should wait for the lines to cross above the zero line. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.